the US increases its debt by 1 trillion every 100 days nowadays. So, I mean, we can easily be at 40 trillion by the end of next year. Green line is the index of US government bonds adjusted by
Oh,
the inflation rate. So you can see that the divergence start really by 2020, by the COVID pandemic. This is from that point that we have seen bondholder losing money in real term.
you always talk about the reason gold is like a hedge, not against inflation, but against the government. Can you elaborate a little bit more on that?
I mean, I would say gold is money, everything else is credit, like JP Morgan's once famously said, right? And why you want to own gold is because
Laurent Lequeu is a multi-asset fund manager with a proven track record of managing portfolios for large international, institutional, retail, and high net worth clients. With expertise across major financial asset classes, bonds, equities, commodities, and currencies on a global scale, he is now an independent financial consultant and the founder of the Macro Butler newsletter. Maybe, Lauren, before we get started to really delve into today's topic, which I know a lot of them are very, very excited to know, can you just share with us a little bit more about your investing background first? Because you shared with me just now before the interview that you actually started investing when you are age 13 years old. 13. That is super, super amazing. What triggered you the interest to start at such a young age?
Well, as I said, when I was 13 years old, I spent my Saturdays. At the time, there was no internet, no TikTok. So I spent my Saturdays reading the newspaper, and I almost always stop on the stock market page, and I manage a paper, a portfolio in a handbook, and also I started to invest in specific stock with my pocket money, and
Wow.
that's how it started. And then I study finance, and then I manage money for others investor now.
So I believe you are from other countries. May I know where are you from, and how long have you been? Currently, you are living in Singapore, right? How long have you been staying here as well?
Yeah, so I'm from Belgium, as you can hear. I've been in Singapore for almost 9 years now.
Uh-huh.
And yeah, it's work that brings me in Singapore. And also, I've always been also interested in Asia. I work for Japanese in my previous career, and then that's why I arrived here in Asia and in Singapore.
Wow, that is great. And I know that on LinkedIn, you publish a lot of insightful articles, right? Your newsletter and all this. And recently, okay, you actually talk about this very interesting thing that there is a risk of a bond bubble bursting. Can you firstly share with us exactly what is a bond bubble and why do you think there is this risk?
I took the example of the US, which is kind of a proxy for what's happening in the developed world or the Western economies. So in blue, you have the public debt to GDP ratio. So I took this chart, about a 25-year chart. And you can see, in fact, that the big change that has happened in public financing started around 2008 when we had the GFC, the global financial crisis. And since then, in fact, the ratio of public debt to GDP has only an increase. And of course, we peaked during the COVID crisis of 2020. And from there, we pulled back a little bit, but I mean, we are still above 122% for the US. To give a sense, in Japan, this ratio is above 225%. So it's
Oh,
the
wow.
level of the US. And then I put the price of gold and the price of US bonds in red and in green. And you can see, in fact, what's I think is interesting, there's quite a good correlation between the price of gold, adjusted to inflation, and the evolution of this public debt to GDP ratio. So clearly, you can see that the governments, it's no secret that more and more debt is issued to finance the green revolution, the reshoring, the friendshoring, and any kind of social program in the Western countries. And this means that
can I just interrupt a little bit? So I understand the blue line is that debt to GDP ratio. What is the red line?
Oh, the red line is the price of gold adjusted to inflation.
Oh, okay. Oh, so the
you can
green
see
line
that
is
in fact,
inflation.
in the 1990s till just before, a bit earlier than the GFC, the price of gold adjusted to inflation was going down. And in fact, in 2004, 2005, gold already sniffed that something was coming up. If you remember, the big financial crisis was in 2008, but gold sniffed something. And in fact, you can see that if you look at today, 2024, it looks that gold is already also sniffing something coming up. That all debt will be issued, and I think that we all know that. I mean, the US increases its debt by 1 trillion every 100 days nowadays. So, I mean, we can easily be at 40 trillion by the end of next year, in fact.
So what do you think is the consequences of keep on issuing debts like this?
Well, the consequences is that more bonds are issued, right? So, in fact, it's not really a problem until there's a demand for bonds and until the inflation is low. So, if inflation remains low, as it has been the case till almost, I would say, before COVID, you see the green line is only going down very significantly after the start of the COVID pandemic. And there are two reasons for this. The first reason is that with COVID, we had a reacceleration of inflation. So clearly, 2-3 years ago, when the government was selling government bonds at 2 or 3% yield on the 10-year yield, and you have inflation moving towards 4, 5, and then 9%. Clearly, there was no interest of investors to buy a government bonds. Then we had a second issue in 2022. In 2022, we had the start of the war between Ukraine and Russia, and the US decided to freeze Russian holdings in Western banks. And clearly, this has been the second reason why the demand of bonds, especially from emerging markets and from China in particular, has been much less than before. And that's why the price of bonds are going down, in fact, because the yield needs to go up to pay for inflation. Green line is the index of US government bonds adjusted by the inflation rate. So you can see that the divergence start really by 2020, by the COVID pandemic. This is from that point that we have seen bondholder losing money in real terms. What I here is in real terms. So is the price of gold and the price of a US dollar bonds in real term, at inflation adjusted.
It's inflation adjusted. So can I assume that the green line is the bond price? Is that it's
yes, here I put everything back. I put the gold price and that bond index at 100 as of the start of 1993. I think it's more for convenience to show the relative performance of bonds versus gold. You can see that gold underperformed until 2008 roughly. And it's only from 2008 that we have this first spike in the gold price. But I would say bonds continue to remain steady until 2020. And then there we have a very big divergence between the bonds and the gold price, where the gold price is shooting up. On the other hand, the bond prices are going down on an inflation adjusted basis.
So the reason that you just said, the reason why bond price is going down is generally also because the interest rate is increasing. So
I think there are two big reasons I want to simplify for the listener. The first is clearly whatever the Fed tells you, the Fed is behind the curve. The inflation is not going anywhere. We have commodity prices rising. And of course, the government can still manipulate the CPI index and try to smoothen the effect of this rising food prices, rising commodity prices. But I would say that the inflation is back since COVID, and there are too many reasons why the inflation has been back since COVID. Is that rather than relying on China and on other Asian countries, the US government has decided that it has to do everything back in the US or in its what they call friendshoring, so the neighbor of the US. But of course, if you manufacture something even in Texas, it's much more expensive than if you manufacture it in Vietnam. So the cost of everything is going up in the US even more than what we can experience elsewhere in the world. And the second is that there are more and more supply chain constraints. I mean, the geopolitical environment is as it is. There's a war between Ukraine and Russia. There's the issue in the Red Sea. There's tension in the China Sea. So all these are inflationary. I think that investor and listener must understand that we are in an environment where there are a lot of constraints on the supply side. So if the government continue to stimulate demand by giving social rewards and social credits to its citizens, the demand continue to be steady, the supply is constrained, the prices are going up.
That's right. And for yourself, like I know that you always talk about the reason gold is like a hedge, not against inflation, but against the government. Can you elaborate a little bit more on that?
I mean, I would say gold is money, everything else is credit, like JP Morgan's once famously said, right? And why you want to own gold is because if you own this, the physical gold in your hand or in a place where you can store it outside the banking system, clearly this is not a credit to anyone. Since the Roman Empire, people has used gold coins, has used gold bars as a way to trade, and everything that is like what the I'm not a gold bug. I would say I have to say I'm not a gold bug. What the gold bug say is that the fiat money goes intrinsically to zero because it's a fiat money. It can be printed. For gold, physical gold, there's a certain amount of gold that is available at a certain point in time. And this is why, in fact, it has been seen historically as a store of value, as a money, because you are in Singapore, you are in Shanghai, you are in Zurich, or you are in Los Angeles, the same ounce of gold is worth the same amount of money.
Yeah. And today, when I was just watching a video about gold, the amount of supply of gold is actually really very limited. They say that if it's a football field and if you fill that field with gold bar, you can only fill that football field to like about 1.5 meters. That means
yes, I think that's the reason, right? You can always print any kind of paper money, Singapore dollars or US dollar notes, but you cannot print gold.
yeah, exactly. So how long have you been buying gold?
Oh, I've been buying gold. In fact, the first time there was a big scare, I was still in Europe at the time, is during the sovereign debt crisis in
Oh,
Europe, where
okay.
I would say everyone was scared about what happened to the banking system. And this was the first time that I really realized that gold is the only way that you can preserve your savings in an environment where uh, the banking system and in fact at some point the governments could default.
Mm, mm,
I think there's a big what can I say? There's a big misunderstanding from a lot of investors. If you are an emerging market investor, you know that you cannot trust your government because every government default from time to time. There's political unrest, political instability. So if you live in Zimbabwe or you live in Nigeria, you know that you cannot trust the government.
mm,
And that's why emerging markets and Asia have a long history of holding physical gold rather than the Western world, because the Western world has get used uh, to think that the government is safe, and then the debt issued by the government is safe. But I would say, I don't want to spend too much time because it's a bit technical, but inflation, in fact, is a way that the government use to kind of default partly on its debt, because let's say the government, I can give you an easy example. The government issue bonds at $100 today for 10 years. It
mm.
will give you, let's say, 4.5% if it's in the US.
Yeah.
So during the next 10 years, you're going to earn $4.5 on these $100 bonds.
Mm,
And in 10 years' time, you're going to get back $100.
yep.
But today, with $100, maybe you can buy, I would say, uh, a big meal in
Mm,
a relatively good restaurant
mm,
in New York. But in 10 years' time, I doubt that this $100 will still allow you to buy the same meal than as today.
mm.
So the inflation is a way for the government to default, and that's why gold, because it's not the credit or the debt of anyone, is in fact the only way to protect yourself against government risk.
Wow, that is very interesting. Just like what you said, our money actually devalue. So in a way, with the government issuing bonds, they also know that at the end of the day, when they return the money back to the people, the money is not going to worth so much. So that is their way.
Yes, I mean, the only example in recent history where there was deflation is
Mm,
in Japan, right? So
yeah.
Japan had a very big problem because it's a very the government is highly indebted,
Yes.
and the country has gone through 20 years of deflation. Means that for the Japanese government, in fact, uh, the cost of issuing new debt now is getting higher because also there the inflation is reaccelerating.
Yep.
But I would say that in general and in a normal situation we have inflation. Of course, it's seldom that we have more than 2-3% inflation, right? But again, if you take the extreme, and I don't think we need to go that far
Yeah.
than
Yeah. Yeah.
Africa. If you go to Vietnam, Vietnam had double-digit inflation for a number of years in the recent past. So you look at, I mean, if you have traveled and then you use the Vietnam dong, you know that the currency, I mean, has a lot of zero. It's because just that the country has experienced high inflation over the past few years.
Okay. So for yourself, like when it comes to let's talk about a little bit more about gold prices. If you don't mind, I overtake your share screen for a while because I also found something quite interesting
No,
online,
sure. Go
right?
ahead.
So in the past, it has been a long time, right, since the stock market is being matched against gold and see what's the performance, right? So in the past, if you see for the past 5 years, right, the gold price actually overtook the stock market gain. And then, but for the 10 years part, well, the stock market still outperform. And then if it's 20 years, the gold outperform again. And then 30 years, actually the stock price outperform. If you stretch it even further, well, the performance of the gold versus stock market still seems to be very far off. So to you as an investor, or maybe to investors who are listening right now, why do you still think that gold is good to go, even though in the long run, the stock market seems to be outperforming?
No, I agree. Clearly, in a normal situation, the stock market will outperform, and the stock market is the best place to be invested over the long term. If you are 25 or 30 years old, in fact, you should only be invested in stocks. You should only own stocks because your time horizon in terms of using your wealth is around 30 years. So over 30 years, there's no point. I mean, unless we see a situation like in Japan that we have seen, but in general, I would say the stock market is the place to be. I think that my point here is that most investors are not fully invested in stocks, right?
Yep.
Usually, depending on their risk profile, they invest in fixed income and other assets. But I think that the point here is, and I see gold. Gold is an anti-fragile asset, especially in the environment where we are going into, which is structurally, I would say, more risk of inflation, more destabilization in terms of geopolitics. This is what gold will provide you. I'm not telling here anyone to go and invest 100% of his savings in physical gold. This is not the point. As I said, I'm not a gold buck. I like gold because I also think that gold, and as I said, it's a hedging against government risk. It's like the insurance you take for your house against the house catching fire. You don't want the house to catch fire, but I mean, everyone has a fire insurance or a car insurance because in case of you have, that's why Warren Buffett is so successful, right? He's selling car insurance that everyone needs to buy.
That's right.
So here, as I said, in a portfolio, gold is your insurance.
Okay.
It's an insurance if something goes very bad. Means something goes very bad with the government or something goes even very bad for the economy.
So when you talk about insurance, right, what is the percentage that you generally advise, let's say your high net worth clients to own gold out of how many?
I think that in this new environment that we are in, my client doesn't own any government bonds of a maturity more than 6 months. The few bonds they have are corporate bonds of blue chip US corporates. And also the maturity is only maximum 12 months. Why? Because I think that we will see higher inflation, especially after the US presidential election. So there will be better opportunity to buy some more interesting yields down the road. And so in this context, to be honest, I recommend these investors to own at least 20% of their portfolio in physical gold.
Oh, wow.
And
Physical.
I want to make here maybe a bit of a statement.
Yeah.
I know that people will find convenient to buy the gold ETF,
Yes, yes.
because everyone wants convenience.
Yeah.
But if you really want gold to play its role of hedge or insurance against something bad that could happen, in fact, you need to own this. You need to own
So
this.
far.
You're safe. Okay? This is, I mean, because owning the gold ETF will not really help you in case of something goes bad.
Mm. Okay.
I know that the younger people look at Bitcoin, right?
Yes.
But again, if you own Bitcoin via an ETF, it doesn't play the role of Bitcoin. Bitcoin is a decentralized asset, right? You
Mm.
don't want to own it, and gold in a way is also a decentralized asset. You
Mm.
don't want to own a decentralized asset on a centralized platform. So why you would like to own gold on a public stock exchange? It doesn't make sense.
Mm.
I know that there are a lot of convenience, and I understand everyone has his trading account online, and it's easy to buy and sell the gold ETF that trades on the New York Stock Exchange or any other stock exchange. But I don't think here that gold must be seen as a trading part of the portfolio.
Mm.
Gold is the insurance. And again, I come back to this. The insurance, you buy it, you keep it. And every year you renew it.
Mm.
So every year you are supposed to buy more gold rather than trade it and try to be smart and trade the high, buy the low, and so on and so on.
Mm. So just now you said that for people who are in their 25 to 30, ideally should not be looking at gold so early because they have the horizon to be long enough to buy stock, right? So what should be the correct age for people to start looking into gold?
Well, I think that it also depends. You can start to buy some gold at any age. I know that in Asia, when you get born,
Yeah.
you get some gold coins.
Yes.
So you even at zero, at one day, you already own some gold. I would say there's no ideal age. It all depends of the risk appetite of everyone. Someone would like more insurance and earlier. Some other people would like less insurance and later. But I would say that the earlier you start, because this this gold bar will not alter. It's gonna stay there for the rest of your life.
Mm. Yeah. So then that's the question when Vanessa asked then when to use it. She said buy the gold and keep it. Is there any time
Okay,
I should use it?
okay. So ideally, you should never use it. Because ideally, this day of, I would say, this doomsday where everything is down and where you need to use the gold coin will never come. So ideally, you never use it. It's like again, I take back to this
Insurance.
insurance. Ideally, you have never a car accident, so you never use the car insurance, or there's never a fire in your house, so you never use the insurance.
Okay, that's very interesting. That's what Robert Kiyosaki he also said, right? He said he buy gold. Yeah. And it's just
I think that what I want to add here is that you need to get ready, and it's better to get ready earlier than too late.
Then the next question I have is, how do you evaluate gold? Like, do you just buy because you think, oh, okay, I just want to buy some right now, I just buy, or you actually wait for certain, I don't know, like price to retrace or whatsoever before you buy?
Well, I'm not gonna go into the details because, in fact, this is part of the subject of this week newsletter on
Oh,
the
wow.
Substack.
Nice.
I try to find where is gold expensive and where is gold cheap.
Mm,
And here I just look at the S&P 500, like a proxy of the economy, or a proxy of the stock market. It should be a proxy of the economy. So for your listener, I would recommend them to subscribe to my Substack. It's free,
yes.
and to read, because it's a bit technical. But
Yeah.
I can tell you that even that gold is at historical high, gold is still cheap.
Yeah. Even though it's at historical high, it's still cheap. Okay, I see. Yeah, right now gold for those who still are not aware, actually gold price it's kind of like at the all-time high, right? Like the stock market is all-time high as well. So I just put the newsletter that you can subscribe for Laurent's newsletter inside the chat. So make sure you go and subscribe that. There's a lot of valuable insights, and Laurent already mentioned that the next post that he's going to publish, it's about gold, right? How to evaluate gold. So I'm looking forward to that. So now the next question from Ken, right? What's your view on BTC, Bitcoin? Do you see it as a store of value like gold?
Okay, I'm too old. Two points here on Bitcoin. Yes, it's a decentralized asset like gold. So yes, it's a decentralized asset like gold. But I would say the issue is that we have no historical track record of how Bitcoin can be used in time of crisis.
Okay.
So I would say that this still needs to be tested. And then I would say that for a lot of investors, volatility in the Bitcoin price is still too high, which will continue to deter a lot of investors of Bitcoin. And then finally, I have a bit of my doubt about what is really behind Bitcoin, because I mean, not that I'm a conspiracy theorist, but I would think that it's not as decentralized as gold it is.
I
Don't
see.
forget that your Bitcoin, most of them will be stored on an exchange. Huh? So at the end of the day, we know what happened with FTX and also all this. You take the risk of the exchange.
Mm.
Of course, you can store your Bitcoin on
Forward.
an electronic wallet, right? But then it's more like the gold that you have in your safe.
Mm.
But again, if everything goes really bad, your gold coin is here in your hand, right? Will you be able to use your electronic wallet when the power grid is off? That's the question.
Okay, that's interesting. That's right. Okay, so still it's tangible versus something that's in
And I also think that I would say that the main point is that it has not been proven in history. The history of Bitcoin is very short-lived.
Mm,
And to be honest, I know that in some emerging market they use Bitcoin. El Salvador is the most prominent example of this. But
mm,
I still think that, as I said, this gold coin will always feed you. There
mm.
will always be someone that will be ready to exchange meat and vegetable for this gold coin.
I see. So there's indeed like a historical proven track record of
Yes.
regardless how many wars have been through, gold is always there that people value. All right. Very nice. So Daniel has a question. He's wondering what is your thought on the US bond since it has been increasing the debt over the years. So could there be any possibility that eventually when they keep on printing money, any chances maybe the bond will eventually collapse?
Well, I think that we have seen nothing of the eyes of US Treasury yields. I think that we will see much higher yield in the next few quarters and years. And so I'm very bearish on bonds, and in particular on government bonds. Because I think that whoever win the election in November, there's one certainty is that we will see more money printed.
Yeah.
We will see more budget deficits.
Yeah.
And also, you must remember that a big part of the US debt is owned by foreigners.
Yeah.
And these foreign investors are not keen anymore to buy these bonds. In fact, China is holding its US treasuries for political reasons. And so clearly, I would say that at 4.3, 4.5% on the 10-year yields, you are not remunerated for the risk of these government bonds. I think that a lot of investors have not yet understood that the government bonds are a risky asset in the environment that we are going into.
I see. So what about how about money market funds that also buy all those bonds and all this? Do you personally think it's considered safe for money market funds?
Well, money market funds at the end, you buy the short end of the curve, right? Between 1 and 6 months, depending on which kind of money market fund. I mean, if I take the US money market fund, I guess they will give you the $1 NAV every day. But again, I would say this is more for your cash management that you should use this money market fund. I would say that, and I think that something that I think we are going into is in a new era where the confidence in private companies is higher than in the government. And here I take the example is, as a bond investor, in fact, you are better to own Apple bond rather than the US government bonds, because at least Apple is selling something, and Apple will always be able to raise the price for its iPhone, right?
Yeah.
The government is selling nothing. And as also, as I learned, one of my teachers always told me when I was at university, if a company default, at least there's something that the bondholders can get back, right? Apple has some asset, there's all these headquarters, all these patents they have on iPhone and so on. If the government defaults, and I take the example of France, the government default, what you can only get is Mona Lisa in the Louvre, right? Yeah. So it's unlikely that you will get back something. So as I said, I would much be more comfortable with short-dated, what I call investment grade US bonds. So all these high-quality companies that, I mean, all the companies that are owned by Warren Buffett have a lot of short-dated bonds. You can invest your cash as well.
That's right. Wow.
And also I want to say there's something good in the US is all these bonds, minimum amount is only $2,000 US. So it's not like you need to invest a big chunk of money in a single bonds. You can buy, I would say, a relatively minimum amount in these bonds, in these corporate bonds.
Interesting insights. All right. How many of you find that whatever things that Laurent has been sharing has been useful? If been useful, can you type useful in the chat? All right. So the next question that I want to ask is, what's your opinion on China? Do you personally invest in China? If so, how do you do it safely?
Okay, I think China is very difficult but I try to summarize. In fact, I write something on China 2 weeks ago. The title was "Make China Great Again." It's a bit provocative, but in fact, it's what Xi Jinping is up to. He's up to make China great again. So how do you make a country great again? In fact, in China, the government and the economy is managed for the bondholders. the economy is managed for all these bondholders who are investing in renminbi bonds. Why? Because the way that you make a country grade is by a strong currency. And here, I mean, also this is the trend of the post-COVID is the de-dollarization. So it's a big word that is used in the media. I think it's a slow process. But you have to understand that China is not managing the economy until the next presidential election in 6 months' time. The time horizon of the Chinese government is in decades. And so I would say, and in a nutshell, and if I mean the listeners are interested, they can also go and read my Substack on Make China Great Again. China is now managed for bond investor, not really for stock investor. Although you can do it, it's a bit difficult if you are not Chinese national, I would say. The ideal would be to invest straight away on the domestic Shanghai market in renminbi bonds, or even for those who have an appetite in renminbi denominated stocks. But for most of us, it's not really possible. I would say the best would be to look at stocks listed in Hong Kong as a proxy. I would avoid at any price ADR. I think that ADR, those China companies listed in the US, could be in the crossfire of the US-China trade war, economic war, or even kinetic war, if we reach that point at some time.
I see. So best is to invest in the local market in China to de-risk. And at the same time, if it's possible, well, China bond is probably a safer asset.
I would say if for those who want to own some bonds in their portfolio, they should look at Chinese renminbi bonds, or also emerging market local currency bonds. Because if this de-dollarization process is going through, and it's going through, it's a slow process. In fact, a lot of emerging market currencies are still widely undervalued. Of course, here I don't give any financial advice. I would say it's for educational purpose only. Yeah? I forgot to mention it.
That's right. Yeah, we all need to do our own investment research. So be responsible for our own. So wow. Daniel is asking, do you have any book recommendations for asset allocation?
Oh, not really. I mean, all the books that are written on that subject are very, very technical and are not really practical for investor. I guess that the best way is kind of first you should consult an investment counselor. Whatever is your wealth, I would advise to have a good investment counselor and to know your risk and your time horizon of investment. As I said, if you are in your 20s, 30s, you have 20 years in front of you, my advice is always first, dollar cost averaging. Buy a bit every month. The $200 or the $500 you save every month, rather than spending on Starbucks coffee, go and buy Berkshire Hathaway stock, or buy a good diversified ETF. You will be better. You don't need to go into the actively managed fund nowadays. But and then if you have a relative long time horizon, as I said, you should be mostly in stocks and start to accumulate some physical gold for your old days, or to give to your child when he's born.
Interesting. So talking back about portfolio construction, right? So you talk about buying gold as an insurance can accumulate about 20%. What do you think about other assets? Like, for example, how much should we be invested in stocks? How much should we be keeping as cash, given the current market situation?
Well, it depends on your risk profile, but I would say if you are this person in his 20s or 30s, in fact, the balance of your portfolio should be in stocks. And I would recommend I give usually a very simple way to manage your stock allocation. You can get exposure to the best stock picker on Earth and from all time, which is of course Warren Buffett.
Yeah.
Because he knows what he's doing. He has a long-term time horizon, and usually he has the good timing because he always has the cash when everyone ends to be naked out of the sea. And other than this, in fact, in this current environment, I kind of look at what I call the barbell equity portfolio, which is basically big tech and big oil and gas stocks. And it matches a bit of what Warren is doing. He's also in insurance, but I don't understand so much insurance as he does. So I would say big tech and big oil and gas stock, because this is, I think, a good way to diversify your portfolio.
Why oil and gas? Like recently, Warren Buffett actually has been buying oil and gas, like acquiring more and more of Occidental Petroleum and all this. Why do you think he's bullish on this? And what's your take on that?
I think he clearly sees that there's an issue of supply and demand coming in the oil market. I mean, I know that the banks and everyone is talking about ESG and so on and so on, but we need to be realistic. If we want to keep the light on and we want to have AI, we will need more energy. And today it's mostly coming from oil and gas. In Asia, still a lot of coal. In the future, probably uranium. But I would say oil and gas. Why oil and gas? Is because there's clearly an imbalance between supply and demand over the long term. I don't know if the oil price will be 85 or 65. I would say I'm like Warren. If you ask me the oil price tomorrow, I have no clue. But I would say that the oil and gas industry will also give you a good edge of what is all this inflation coming, because usually the inflation is driven by the oil price in a way.
Yeah. So how do you advise investors like us, normal retail investors, to invest in oil and gas? Like buying oil and gas company, or I don't know, buying oil?
I mean, you cannot, unfortunately, it's much more difficult to store a barrel of oil than this. So it's very difficult. So the best way is the way as Warren do it, is to look at the big major oil and gas company. I would say here also, this is not an investment recommendation, but there's an ETF in the US where there's all the big names, the Chevron, the Occidental Petroleum, the Schlumberger, the ExxonMobil. So, I mean, these guys will do well. I think that Warren knows better than Chevron will do better than Exxon, but I'm not as smart as Warren. So I'll leave it to Warren for the stock picking. For the sector, I would just buy the big ones.
Sounds great. All right. Wow. Yeah. And then you use the barbell. The other end will be the big tech. That's how you have both end to hedge.
Yes, because I mean, the tech is the growth, right? The growth will come from the Microsoft, the Apple, and all the big tech companies. and it's a hedge against, let's say, if we find the unexpected source of energy, let's say tomorrow the world wake up and there's plenty of energy available and energy is free. I mean, then the growth will be unlimited. And who is going to benefit from this unlimited growth? The big tech companies. I try, in fact, in my new role, I try to make it simple. I know that a lot of the private bankers like to tell stories because that's the way that they pitch their sales. I make it simple. Is most of the time the goal is not to lose and try to make a decent return, but try not to lose, because I always take this example. I mean, I also teach adult learner, and I always take this example. If you have a portfolio of $100, the portfolio lose 50%, it's worth $50. To go back to $100, it needs to double. So you want to avoid to lose that 50% as much as possible. That's the goal. The primary goal of investing is avoid to lose.
That's right.
Because if you avoid to lose, it will be much easier to generate a return. And I think that this example of if I have $100 invested, I lose 50%, I have $50 left. To recover $200, I need to double. So you imagine the pain to reach back the $100.
Yeah, that's why Warren Buffett rule number one is never lose money.
That's the rule number one of every good portfolio manager should be never lose money. But it's not, I always say it's not sexy.
Yeah.
If you run a fund manager, I run fund for institutional clients before, or I run fund for retail clients before. And if you start your presentation telling them that I'm going to try not to lose your money, nobody is going to invest with you. What they want to listen is they want to listen of the upside potential. They are not interested of the downside protection of the portfolio. And in fact, the downside protection of the portfolio is the most important.
That's right. Again, guys, all these are years of wisdom, investing wisdom came from Laurent. So can everybody type never lose money, right? That should be the most important thing to safeguard our wealth. After all, it's all our hard-earned money, right? Don't squander it. Don't go and chase shiny objects just to want to chase high return. You want to make sure you always come from don't lose money first, right? That is the most important thing. All right. So, and for people who are going to retire, right? What kind of assets do you think that they should hold?
Okay, then here is a problem, because the people who are retiring or retired, they need an income, right? They need the generation of an income. And if you cannot use bonds as a source of income, you are a bit in a difficult situation. So my advice here would be to look at these companies that are giving decent dividend. I'm not gonna tell any names here, but I would say, to me, and we are going back to Omar, this is the best way to protect, to build your retirement. Even you don't get any dividend, but your dividend is in the share price appreciation of the stock. And in that case, just sell a bit as your income.
That's beautiful.
Of course, Warren will tell you never sell.
Yeah. The best is never sell, right? However, just like what you said, sometimes when they retire, they need certain income. Well, no harm selling a little bit, but majority you can still keep.
No, I think he gave a good example at the latest AGM. where someone committed his share to philanthropy, right?
Yeah.
And then the philanthropy had to sell the shares because the philanthropy need the cash. They cannot operate with Berkshire Hathaway stocks as a way to operate. So I mean, he was there and happy to buy back the shares from them. But on the other side, I would say never sell.
I see. Wow. Wow. Fantastic. I think time plus when we're enjoying learning so much from you. And lastly, before we wrap up, what is one final advice that you want to give to investors over here that some of them may be completely new or when they first get started? What's your advice for them?
Be very humble.
Be very humble.
And invest in what you understand. The late Charlie Munger, I think, has teaches a lot of lesson about this. Be very humble, and you can see that even the most successful investor on earth can also make mistake.
Yeah.
And try not to be driven by your emotion. Invest in what you understand, but be very rational when you invest. Don't be emotional. And here I also take an example of Warren. I think on Paramount, he was a bit emotional.
It could be.
He was a bit emotional because to him, Paramount is the Paramount of his young days and all these kind of things. So it's very difficult not to be emotional because it's our money, it's our wealth, I mean, we can feel it, right? When we lose money, we can feel it, but don't be emotional. And don't listen to the crowd. Usually the crowd is wrong. I would say the crowd will push you in momentum trades, which is most of the time a calm trade, as I said. Because it's very difficult to exit at the right time. So invest in what you know, what you understand. Be very rational, no emotion, and stay humble. Everyone makes mistake.
So forgive your own mistakes and most importantly, learn from it, right? That's how you
Of course, learn from your mistake. I mean, I made a lot of mistake in investment because I mean, at some point I was also around during the dot-com bubble, but I learned a lot. And in fact, I started my professional careers in 1998, in August 1998. So it was quite a good time to start, right? When this crisis is the best time to start. I was a fresh graduate, and at the time I was a buy-side analyst in a bank, and I had to stand in front of very experienced private banker and explain them what's happening with the dot-com and so on and so on. And I think I learned from there that you need to understand what you buy and don't follow the crowd, because most of the time the crowd will push you in something that you don't really want to do, in fact.
So you literally see the stock market drop, I think at that time, 70 to 80%, right?
Yeah, I was in Europe at that time, so it was not as bad as in Asia.
US, okay.
But I remember I just started a few weeks before the default of Thailand and all these Asian tigers. So it was quite an experience.
Wow. And it's all this experience that groom you and nurture you to become better and who you are today. Wow.
And also maybe the last word is take your time. If an investment story is good, it's going to be good for a long time.
That is
You don't need to be in a hurry. Take your time to understand what you are investing.
Wow, how beautiful. Thank you so much for all your kind sharing. And I'm also very curious from our audience here. Can you guys type down what is your greatest learning from Laurent during this very special sharing? Put it in the chat. I'm very, very sure Laurent would love to see as well. Bino said that appreciate the invaluable insights. gonna ask for physical gold for every year's birthday present. Wow, I would love that too. Okay. Okay. Gold is still gold. Irene said gold is still gold, right? Having the actual gold is better than the intangible gold out there, right? Love that. And make sure, okay, Lauren, if they want to follow you, where can they follow you?
Well, they can follow me on LinkedIn. I'm also on X. But I'm also much more, I mean, I have my macro Butler Substack where you can register for free.
So make sure you guys go to this.
And on LinkedIn is under my name where I put more and I talk about everything, even the geopolitical situation, climate change, and everything. And also, I started to use AI. As you can see, I tried to learn how to use Midjourney. I'm still a beginner. And
Wow. That is beautiful.
I try to make it fun, at least make it attractive for people to learn.
Yeah. And you guys, if you go and read the newsletter, you will know that actually Lauren put in a lot of work and effort in putting up all this summary inside. So if you are very interested in to learn about the macro data and to just be more aware of what's happening in the world, have a more unbiased view towards it, then make sure go and subscribe and you will definitely learn a lot more from there as well. All right. And
yes, I always have every week kind of a big summary of what has happened over the week. It's called the week that it was. And then after there's a weekly topic for everyone to learn something about different things. I try to touch on every subject that I think are important for investor in general. It's not only macro investor.
Wow. Thank you so much. We look forward to learning from you more from reading your newsletter. And the next one you're publishing is about how to evaluate gold. So I will definitely keep a lookout for that. And everybody is like giving you thumbs up, say, oh, they already subscribed. But Bino said that they already subscribed. Yeah. So make sure go subscribe and most importantly, go and read it. Then that's how you can get to benefit from Lauren's output as well and his work. So thank you so much.
Also, if I can,
sure.
At the end, there's the key takeaway, where it's like 10 bullet points, where I try to summarize for those who have no time to read the whole newsletter, where there's a summary of what you need to remember of the week.
So guys, when you scroll through, right, you see, until now, I'm still scrolling through. This is like an essay,
the key takeaway.
It's a research paper. This is the one, right? Key takeaways. This is the one, right? So these are the key takeaways, a summarized version of the entire newsletter. So if you have very little time, go and read this first. And you will save a lot of time and then still get the insightful nuggets from the newsletter as well. All right. So thank you so much, Lauren. Hope to catch up with you in person in Singapore. After you come back from Chiang Mai, I will definitely contact you and let's catch up for more as well.
Sure. It's a pleasure. Thank you for having me.
It's a pleasure of us to have you here tonight and looking forward to learning from you more as well. Thank you so much, everybody, for joining us. I hope you guys enjoy it a lot and most importantly, and stay invested. Just like what Lauren said, like you can start small, like just dollar cost averaging into great companies, into great index, and then buy some gold for insurance. That's how we are going to improve as an investor as well.
Thank you.
Thank you. Thank you, everybody, as well. Thank you. Arigatou gozaimasu. Bye bye.